One of the biggest things that my clients are thinking about when selling a primary or investment property is the capital gains that they're going to be paying. Now, when you think of an investment property, you have things like 1031 that you could defer the capital gains and be able to build and improve your investment portfolio. But what if it's a primary residence? Well, obviously you have the section 121 where you can write off the 250 or $500,000 if you're married, but that's really just scratching the surface. Now, I can't give any legal or tax advice, but I actually want to read off, so it's going to be a little bit more of a raw video, reading off some of the different ways that you could actually defer capital gains on a primary property or an investment property, because 1031 and then just a 121 deduction ability for a primary residence, like I said, those are just two potential ways that someone could potentially defer capital gains. There's a lot of other options, and I have great contacts and resources because I can't give any legal or tax advice, so I'm just going to be reading off of the script of what different options there are when it comes to deferring capital gains. And if you want to actually meet with me where I could connect you with one of my many different resources for someone who could actually execute this, not only just execute it, but walk you through all the different potential options, tailor a campaign, or I guess tailor a solution that's going to work for your exact situation. I have those contacts, and that's one of the key things that I wanted to be able to build my business on, is making sure that I have all the different resources, vendors needed for my clients, whether they're selling a property, buying a property, or doing anything else in that matter, right? I want to make sure that I'm able to connect them with trusted contacts. So I have contacts to help you defer capital gains. But let's dive into the video where I could actually walk through the different ways. My name is Jarrett Richards. I'm an agent with Berkshire Hathaway. Hit that subscribe button, like this video for more content just like this. But let's go ahead and dive right into the video. So let's start with the primary residence. When you sell, you have the section 121 deduction. So if you're single, it's $250,000. If you're married, it's $500,000. Well, one strategy is to actually, I guess, take that primary property, convert it into a rental property where you could defer capital gains, but you're still going to be deferring. So there's still some pros and cons with that strategy. If it's an investment property, well, then obviously you have the 1031 that you could essentially utilize already, but that is one strategy that people do sometimes utilize with their primary residence, turn it into investment property. But one of the biggest things that I also want to consider is, does that actually make sense? Because if you turn it into investment property for more than 5 years, well, now you don't get to benefit from the exclusion for the 121. So that's one thing to keep in mind. Sometimes you might be forfeiting that $250,000 or $500,000 if you make it an investment portfolio property, rather than actually just selling and going about some of the other creative ways that we could defer capital gains. The second strategy is going to be depreciation planning. So if you convert it into a rental, you could also take the depreciation, which is great because you could even accelerate it with cost segregation. So that could create paper losses to offset income before you sell. So that's one creative way that we do see people utilizing, deferring the rental income, because obviously in Orange County, we have great appreciation, but we don't have that good of a cash flow cap rates in this current area. 2 to 3% is what you usually see. So unless you bought that house many years ago, you can imagine your cap rate is not going to be all that beneficial, which is why some people actually want to take advantage of that to be able to take advantage of the depreciation on their rental income. The third strategy is going to be an installment sale. So this is where it starts to get a little bit more creative. Basically, seller financing. So instead of getting all the money up front, you spread the gain over multiple years, and essentially you could even reduce your tax burden, which is nice. The other thing that you could potentially even utilize with this is offering a cheaper interest rate that banks aren't able to compete with. So you could definitely get pretty creative here when it comes to seller financing, and then being able to get creative with the tax aspects later on. But that's obviously why I have tax resources for people that could actually execute all of this, not just talk about the options. So again, as I continue through this video and walk through the different strategies, I have contacts. If you want me, I could actually connect you guys so we could look at your exact situation and tailor it for what you need, right? Because obviously I can't give legal or tax advice, but the fourth strategy is going to be opportunity zones. I mean, this essentially when you roll your gains into a qualified opportunity fund. So definitely more creative, but that lets you defer the taxes and potentially eliminate taxes even on the new investments growth. I would need my contacts and resources to dive further into this because I just don't want to give any legal or tax advice. As I keep mentioning, you're going to hear me keep saying that, but that is a fourth strategy that some people do utilize. The fifth strategy is going to be gifting and family planning. So you could definitely transfer the property to family members, but keep in mind they inherit your tax basis. And if it's not a primary property, tax 19 will kick in, where essentially that tax basis will be reassessed. So that's also something to keep in mind. This is more of a long-term planning tool, not necessarily an immediate solution, but a strategy nonetheless. So that's why we're including it. The sixth strategy is going to be a charitable remainder trust. This is more advanced, using a charitable remaining trust, but essentially you can sell the property inside a trust, defer the capital gains, receive income, and then get a charitable deduction. Pretty creative. Again, I have resources to walk through all of this, and they can answer any questions you guys have, because I'm just going over the different options. The seventh strategy is actually going to be a step up basis, or step up in basis, and this is more of a long-term strategy, holding the property until death essentially, and your heirs receive a step up basis in which they could eliminate capital gains entirely. This might be a good option for you, but as you can see, we are starting to get more advanced with the tax strategies. So essentially the eighth strategy is you could also increase your basis. So don't forget to track all of your improvements, the renovations, and the closing costs, of course, because those are all things that you could also write off. Essentially increases your basis and directly reduces your capital gains, so your taxable income, or taxable gain, which is great. So essentially part two is going to be more geared on investment properties. So obviously, as we mentioned, the 1031 strategy. So that's the most common. It allows you to sell, reinvest into another property, and then defer all the capital gains and the depreciation to be recaptured, which is great, right? Because you could also recapture the depreciation and then also defer the capital gains. The second strategy is also going to be 1031, but it's going to be a reverse 1031, so a little bit different. But essentially, this allows you to buy first and then sell later, which gives you a huge competitive advantage, especially down here in Orange County, where if you're making a contingent offer, it's kind of a crap offer just down here, just because of how competitive it is and how little inventory that we have and how many buyers are still in the market out shopping for homes. So things are still moving. The third strategy is going to be a Delaware Statutory Trust, a DST. So essentially, if you're tired of managing property, you could 1031 into a DST, and basically it provides passive ownership in large institutional real estate. So definitely a creative option, might be an option for you. The other fourth strategy is to obviously just trade up into bigger deals. So, I mean, really it's just going back into a 1031, into a development or value add deals that force appreciation while deferring the capital gains. So that's one advantage that you could essentially utilize. The fifth strategy is actually going to be a 721 exchange, which is an UPREIT. This is a lot more advanced, but essentially a 721 exchange allows you to exchange a property into a REIT and basically receive shares instead, which also allows you to defer the capital gains while gaining liquidity, which is great. That might be an option for you guys too. The sixth strategy is going to be cashing out and then refinancing, or don't sell at all, and essentially, like I just said, you refinance, pull the cash out tax-free, and then you keep the property. So instead of selling, that's one way that you could potentially utilize that. But the other way, seventh strategy, is going to be the installment sale. So same as before, you can structure the sale to spread taxes out over time. The eighth strategy is also going to be an opportunity zone. So again, you could roll the gains into an opportunity zone investment for deferral and potential tax-free growth, which might be a creative strategy for you. Same thing with investment properties. You could also go the charitable trust route. So again, charitable trust can convert taxable sales into a tax advantage income stream. Something to consider if you guys are in that situation where you guys need some serious capital gains deductions. The 10th strategy is going to be cost segregation. So again, you could use cost segregation and bonus depreciation to offset gains from other deals, getting more advanced and creative. The 11th strategy is going to be an entity structuring. So obviously how you structure ownership, LLCs, partnerships, it could definitely impact how flexible you are with all of these strategies. So that's why I have the contacts and resources needed. If you want to sit down with a tax professional, a wealth management, for a no obligation consultation to walk through your exact situation on how you could actually defer your capital gains on a primary or investment property, go ahead and contact me directly at 949-405-4455. Again, my name is Jarrett Richards. I'll connect you guys, because this is one of the biggest things, is how do we defer capital gains? How do we minimize what we're going to be paying on a sale if it's an investment property or a primary property? Because nobody loves to pay taxes. We want to reduce that as much as we possibly can. So obviously, if you're in California, this video is more curated for you. There's probably many other strategies, and I probably could have done a much more in-depth video on breaking down these different options. But again, I can't give legal or tax advice, so I just kind of want to do a generic overview to what these strategies are and how you might be able to potentially take advantage, and give you kind of just an idea, some little points to be able to reflect on and do some research on yourself, because like I mentioned, I have the context needed to be able to not only plan but also execute all of this to be able to help you from a financial standpoint. Because what I really want to do is make sure that when we sell the property, because the marketing, the pricing, both of those are extremely important, but we also want to make sure that the financial game plan for what you're going to be paying in taxes is also completely dialed in.